Okay, be honest with me for a second. Have you ever wondered why your breakout trades at those incredibly obvious highs and lows just fail? Like exactly when they look the most promising. You spot the resistance, right? Price blasts right through it, you excitedly hit that buy button, and then, boom, the market instantly reverses, takes out your stop loss, and then rockets off in the direction you actually wanted. Welcome to this explainer. Today, we're going to unpack exactly why this happens, and more importantly, how you can actually use it to your advantage. Look, if you felt that massive frustration of getting stopped out on a seemingly perfect breakout, I promise you, you are absolutely not alone. What you're experiencing is the classic retail breakout trap. It's a huge pain point for traders literally everywhere. But here's the thing, it isn't a coincidence, and it's sure not just bad luck. It is a fundamental structural mechanic of how the markets actually operate. By the end of this explainer, you're going to understand that your stop loss isn't just a safety net for you, it's the exact fuel that the big institutional players are out there hunting. Here is our quick roadmap for today. First, the retail trap. Second, liquidity mechanics. Third, mapping key levels. Fourth, kill zone timing. And finally, number 5, the turtle soup strategy. Part 1, the retail trap. So, to stop falling into this trap, we really have to get inside two vastly different mindsets: the everyday retail trader and the institutional algorithm. Now, retail traders are usually taught to reflexively buy breakouts, right? When price pushes above yesterday's high, the retail brain screams, momentum, buy, buy, buy. But institutions? They operate on a whole different level. They deal in such massive volume that they literally can't just enter a trade without moving the market against themselves. That's a little concept called slippage. They desperately need a massive pool of buyers to sell their orders to. So, when retail traders excitedly buy that breakout, they are unknowingly handing over the exact counterparty liquidity that institutions need to execute their massive short orders. Basically, you are the liquidity they need. Moving right along to part 2, liquidity mechanics. Let's visualize the battlefield here and define the invisible forces causing prices to react so violently at these extremes. Buy-side liquidity, or BSL, rests just above major highs. Think of this as a dense cluster of buy-stop orders. These usually belong to short sellers trying to protect their positions, plus breakout traders hoping to catch a massive pump. On the flip side, we have sell-side liquidity, or SSL. This sits just below major lows, and it's made up of sell stops from long traders and breakout sellers. These liquidity pools act like giant magnets. Institutions deliberately drive prices right into these pools to absorb all those orders, which lets them build their own massive positions incredibly efficiently. So when price targets these magnetic pools, it creates what we call a liquidity sweep. Essentially, a sweep is a false breakout. The price briefly pierces a key level, triggers that massive cluster of stop loss and pending orders we just talked about, and then boom, rapidly reverses right back into the previous range. If you look at your candlestick chart, a sweep almost always leaves behind a really long wick. And that long wick, that's the literal footprint of smart money. It's basically a massive neon sign signaling that the required liquidity has been snatched up, the trap is sprung, and the real directional move is about to kick off. Part 3, mapping key levels. All right, now that we know what these institutions are hunting for, let's break down the actual hierarchy of liquidity targets on our charts. Think of it like a giant ladder. Down at the bottom, we have session highs and lows, like the Asian session boundaries. These are your intraday targets. Moving up a rung, we hit the previous day high and low, or PDH and PDL. These are your absolute bread and butter, the critical daily targets. Then we scale way up to the macro levels, the previous week high and low. These hold immense gravity because liquidity has been piling up there for 5 full trading days, meaning sweeps here often spark multi-day trends. And finally, sitting at the very top, previous month highs and lows. These are massive macro targets used for institutional quarterly planning. A sweep at these monthly extremes, yeah, that can dictate market direction for weeks. Now, while those weekly and monthly levels give us our overarching macro bias, the PDH and PDL are really what give us our daily actionable setups. What makes the previous day high and low so incredibly powerful is that they are totally fixed. They literally do not change during the current session. Every single trader, every algorithm, and every major institution on the planet is staring at the exact same 2 horizontal lines. And because they're universally referenced, the order accumulation around them is highly predictable. That makes them the absolute most reliable liquidity pools to target on a daily basis. Which brings us to part 4, kill zone timing. You see, the trading day has a very distinct rhythm. Trading these levels successfully isn't just about price, it's highly dependent on time. The Asian session, for example, is known for low volatility and really tight ranges. Its strategic role isn't to create massive moves at all. It's just there to build up those liquidity pools. It just accumulates orders around the boundaries. Then, the London session opens up with huge volume and typically steps right in to sweep that accumulated liquidity, often grabbing the Asian high or low or going for the wider PDH or PDL. Finally, the New York session rolls in, bringing the highest volatility of the day, and it usually either fiercely reverses the London move or aggressively continues it based on incoming U.S. economic data. So if you want to catch the absolute cleanest liquidity sweeps of the previous day high or low, you've got to focus on what we call the kill zones. The London Open, which is roughly between 2 a.m. and 5 a.m. Eastern Time, is the prime window. During these 3 hours, institutional participation absolutely spikes, and smart money steps in to sweep those boundaries and establish the real direction for the day. Honestly, a sweep of the PDH at 3 a.m. during the London Open carries significantly more institutional weight than some random sweep in the dead of the Asian session. All right, part 5, the strategy, playfully known as turtle soup. With our locations and timing locked in, let's talk execution. This step-by-step framework is widely known as turtle soup. Basically, it's a liquidity-based reversal model that deliberately fades false breakouts at higher timeframe areas of liquidity, like the PDH or the previous week high. The name is actually a fun contrarian jab at the famous 1980s turtle trading system, which was built entirely on buying breakouts. In our strategy, when those traditional breakouts inevitably fail, the trapped retail traders become the soup that feeds the institutional algorithms. I want you to remember this concept. The sweep collects the liquidity, and the reversal is the real move. This perfectly captures the whole philosophy here. What this means is you must never, ever trade the simple touch of a level expecting it to hold as some unbreakable wall of resistance. Do not just place a blind limit order exactly at the PDH. No way. Instead, you wait to trade the failure of the breakout. You patiently wait for the trap to be set and then sprung. Okay, here is your daily execution mantra. Step 1, wait for the sweep. You want to see price push past the PDH, PDL, or a session extreme, and then close right back inside the range, leaving a noticeable wick. Step 2, confirm the shift. Drop down to a lower time frame, like a 5-minute chart, and look for a market structure shift. You need to see a clear break of structure in the opposite direction of the sweep. This proves that momentum has actually changed hands and confirms the reversal. Finally, step 3, enter the trade on a pullback into that new structure and target the opposite liquidity pool. So wait for the sweep, confirm the shift, target the opposite. Now, any good strategy absolutely has to protect your capital. A critical rookie mistake traders make is placing their stop loss right at the exact price of the PDH or PDL. Remember, price just sweat that level, it might probe it one more time. You have to place your stop loss just beyond the extreme wick of the sweep candle. So if you're shorting a PDH sweep, your stop goes slightly above the highest point of that specific spiking wick. This simple tweak protects you from getting stopped out by a sneaky secondary test before the real reversal even develops. We've covered a ton of ground in this explainer today, from the psychology behind the retail trap, to the daily, weekly, and monthly hierarchies of liquidity, all the way down to the exact execution steps of the turtle soup strategy. So I'll leave you with this. If you now know for a fact that algorithms are systematically hunting retail stops at these obvious levels every single day, how are you going to look at your charts tomorrow? Are you going to continue being the liquidity fuel for institutions? Or are you going to patiently wait for the sweep, confirm the shift, and start trading alongside them? The choice and the edge is now entirely yours.